Okay, ladies and gentlemen, we have a bit of a problem that honestly could be big for markets. Donald Trump last night threatened a 100% tariff on the BRIC bloc of nations if they act to undermine the US dollar. Now, this is what Trump posted on Truth Social, on Facebook, pretty much everywhere. It says, the idea that the BRICS countries are trying to move away from the dollar while we stand by and watch is over. We require a commitment from these countries that they will neither create a new BRICS currency nor back any other currency to replace the mighty US dollar, or they will face 100% tariffs and should expect to say goodbye to selling in the wonderful US economy. They can go find another sucker. There is no chance that BRICS will replace the US dollar in international trade, and any country that tries should wave goodbye to America. These countries include Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Iran, and the United Arab Emirates. Turkey, Azerbaijan, and Malaysia have applied to become members, and several other companies have expressed interest in joining. So yeah, a good chunk of the world in which we do business with is currently in the BRICS alliance, including India and China. Now, I clearly have a couple of thoughts on this because first and foremost, it could be good because 10-year treasury yields. Now, assuming none of these countries want to actually leave the US economy, assuming that's true, which I think is the most likely outcome, then you will see more demand for US dollars. You will see more business with US dollars and more US debt that gets bought. When more US debt gets bought, well, treasury prices go up and yields go lower. So this could actually bring yields lower if the bull scenario plays out here. Now, that's the bull scenario. If the bearish scenario plays out and Wall Street gets fearful about potentially a 100% tariff on China, you could see how this could become a pretty dicey situation for markets. So really, to start off this upcoming week, I think it's going to be about this 100% tariff threat. I think this is a big fishing move by Trump. He's basically throwing out, the bait and seeing if the markets react to it. And we'll see if the markets react to it. If there is anything that's going to crash markets in regards to tariff, it's going to be this 100% tariff threat. Now, do the markets look at the probability of this? Do the markets say, hey, is China really going to back out of the US market? Is India really going to back out of the US market? Probably not. So if the markets just blow this off, then you're good. I wouldn't worry about tariffs at all after that. If Wall Street trades down and we go into a correction, then that's a bigger problem. And yes, this could cause a correction in this upcoming week if markets freak out about this 100% tariff. Now, again, just to be clear, this is a good policy for America forever, okay? Right? This is just a good America first policy. And I think it makes sense. If you want to go skirt around the dollar, then why should you do business in the most successful, most developed country in the world? I think that's just a fair deal, right? But if Wall Street takes this as, in the near term, negative, that China may actually get a 100% tariff, which I don't think anyone thinks that's going to happen, but Wall Street is going to make their own assessments of this, then that would certainly cause a crash and or correction in markets and could be a pretty rough December. So I think tomorrow's trading day will be very important because, let's be honest, is India or China really going to come out and say, yep, we're going to accept this 100% tariff? Obviously not. I mean, we'd seen how fast Mexico's president quote unquote solve the immigration issue, the border issue, after Trump threatened only a 25% tariff. And you have seen Justin Trudeau in Mar-a-Lago trying to cozy up to Trump also. So I doubt 100% tariff is really a problem in the reality of this situation, but Wall Street could be nervous about this. Now, another big theme of markets for this week is going to be the economic data. So starting off on Monday, you will get ISM manufacturing PMI. I don't think this is too important because manufacturing's been in a recession for a long time. It's been negative for like 2 years now. If manufacturing's weak, well, that's kind of the same old, same old. If manufacturing gets surprisingly better, then that would obviously be good news for markets. But should we count on that? Probably not. You have a 3-month and 6-month bond auction on Monday as well around noon. Fed Waller and Fed Williams will also be speaking. Now on Tuesday, we will get JOLTS job openings. You're expecting 7.38 million, down from 7.44 million last month. So basically, think about it like this. If you have a Dollar General or a McDonald's, whatever it is, looking to hire 5 employees, odds are that business, that establishment is doing well. If they then drop that down to 2 employees, you could say maybe the business has slowed down. They don't need as many employees, right? Same is true with JOLTS job openings. The more job openings, the stronger indication of a stronger economy. Less job openings, especially job openings that fall rapidly, is a sign that the economy could be weakening more than we expect. So if JOLTS job openings come in low, and if you see a big drop, that's a problem. If JOLTS job openings come in, in line with expectations or higher than expected, that is actually a good thing. Now, Fed Kugler will speak as well as Fed Goolsbee Tuesday afternoon as well. So that's your big catalyst for Tuesday's really JOLTS job openings. Wednesday, you will be getting the ADP employment change. You're expecting around 165,000 job ads for this private payroll report. And this is a heads up of what to expect on Friday. So markets will pay attention to that. ISM services PMI will be very important because services is like 80% of the economy, okay? But it's kept the economy running, really. With manufacturing being in a bad place, services has picked up that slack. Now, if services comes in low for whatever reason, then we have a bigger worry on our hands. Then, you can't have manufacturing and services doing bad. You really can't have services doing bad at all because manufacturing is not going to make up for that, right? Not in this day and age. So services will be important. You're expecting the service PMI on the headline number to come in at 55.5. Anything above 50 is positive. Anything below 50 is contraction. So you're still expecting a positive number here, but that would be down from last month where you came in at 56. I think there's a good chance that we actually come in stronger than expected there, and Wall Street would love that. Now on Wednesday, pop-up speech here, this just popped up. Fed Chair Jerome Powell will be speaking on Wednesday at 1:45 p.m., right ahead of the Fed Beige Book that will be coming out at 2 p.m. So the last time I looked at this economic calendar, I did not see a speech from Powell. So I think that is new there for Wednesday. Now, Thursday, you will get exports, imports, and the balance of trade. This will influence the Atlanta Fed GDP Now tracker, and you will get a new GDP update. Currently, you're expecting 2.7% GDP in this current quarter that we are in, but as more data comes out, those numbers get refined a bit, and you see GDP move around. Now, you will get initial jobless claims, expecting 220,000. Last week was 213,000, and we've really been surprising to the downside, which is good, for a couple of months now. It seems like maybe 4 to 8 weeks now, and that has helped keep markets in check. The last growth scare we got in September, it was initial jobless claims that started to skyrocket, that kind of led that that growth scare. So as initial jobless claims have come down, some of the worry about the economy has also come down. Now, Friday is your big data. We will get non-farm payrolls, expecting around 183,000. But keep in mind, last month, we only had 12,000 job ads. Some people said this was due to the hurricane. Some people said this was due to the Boeing strike. And markets actually went higher on this day that we got that 12,000 jobs report. It actually went up quite a bit, over 1% across the board. Now, in this jobs report for November, you'd expect to see those manufacturing jobs from Boeing come back onto the payrolls, which is going to be more or less about 50,000 jobs, 45,000 jobs or so, and the hurricane impacts to go away and those jobs come back onto payrolls for the large extent, right? So you could get a strong number here. You could get a really strong number here. And again, that's good news for the economy, but that is maybe not as great news for the Fed and their cutting prospects. Now, the markets are only pricing in about 2.5 cuts next year anyways, so we're kind of already at that point where maybe a good jobs report doesn't change anything for the Fed or Fed pricing, but is actually just good news for the economy overall. Now, Friday as well, you will get Michigan consumer sentiment, expecting that to actually go up quite a bit from 71.8 to 72.9 in this latest reading. So definitely expecting things to get a little bit better here. Consumer expectations are expected to get better as well, go to 77.3. Current conditions are expected to rise as well from 63.9 to 64.1. Inflation expectations on the 1 year ahead are expected to skyrocket from 2.6% to 2.9%. I don't know what's going on with that number, but given the price of oil has been falling recently, I don't think that's going to happen. So maybe we are in for a positive surprise from the Michigan consumer sentiment on Friday. You will also get Fed Goolsbee, Fed Hammock, and Fed Daily that will be speaking Friday afternoon as well. Bitcoin currently sitting at $97,500. So it doesn't look like some of these Trump tariff issues or worries have really impacted that so far. So that's good. That's a good sign, at least heading into this upcoming week. Now, the S&P, just in general, alongside other risk assets, have done well. They closed, at least the S&P closed at a new all-time high on Friday's half day. So if markets do brush off that 100% tariff threat from Trump, the path of least resistance is definitely higher. And I think the economic data for this week, we're kind of set up in a good way, right? As long as ISM services come in good, as long as the jobs report's not a huge miss, and Powell on Wednesday doesn't say anything too crazy or dramatic, then I think markets are going to take this week as a good week and likely push higher. The CNN Fear and Greed Index is sitting at 66, which is higher than where you were previously at 65, about midpoint in greed. Usually when you get into extreme greed is when you start to get vulnerable to market pullbacks, but some of these indicators are just skewing things a bit. Market momentum in extreme greed, stock price strength is neutral, stock price breadth is fear. Put and call options, extreme greed, market volatility is neutral, safe haven demand is greed, and junk bond demand is greed. And there's all of this talk about markets being euphoric or just overly optimistic, and that's really not the case, okay? If you look at the AAII investor sentiment survey, I call it the AI investor sentiment survey, they asked investors what direction do they feel the stock market will be in the next 6 months. Bullish investors are at some of the lowest levels they have been at in months, okay, at 37.1%. Bearish investors are at 38.6%. So you're outpacing the Bears are outpacing the Bulls by 1.5%. That rarely ever happens. The only time you see more people bearish than bullish is when you are in corrections. Okay? Like, that doesn't normally happen. Okay? Your 1-year bearish high was just set on November 27th, last week, at 38.6%. This is the most bearish people have felt in a year. And I think part of that has to do with, so many high bullish price targets coming out for next year, and people are like getting nervous because of that. That's what I think is going on here. That's crazy. Just remember this. You are at a 1-year high for bears. 1-year high for bears. Last week, November 27th, a couple of days ago. And markets are at all-time highs. This is actually bullish, right? If people feel this nervous and this bearish, then there's a good chance that a chase could start for December. And that's exactly what Carson Group's Ryan Dietrich just said on X, that this bull market is setting up a December chase.
Carson Group's Ryan Dietrich. Ryan, great to have you on to really freshen up your view of what this market can do. In so many respects, this market's been kind of behaving as it's supposed to behave, right? Earnings have been going up, stocks have been advancing as well. Seasonal strength has been redeemed. You got the post-election kind of tension release rally. Where do you think that leaves us on this perch heading into next year?
Yeah, Mike, thanks for having me back, and hope everyone had a great Thanksgiving out there. So, I was on, I think it was the Friday before the election with Judge, talking about all the VIX spike and all the puts coming in. We expected to see another strong November. Well, like you said, we're having another strong November, but this year has really played out. I mean, what do we know about December, right? We still think there's more to go to this overall bull market, but really more specifically over the next, 4 to 5 weeks. We know December's up more likely than any other month, up like 74% of the time. It's the most likely to be up in an election year. It's the third strongest year overall, but the second strongest in an election year, only to November. Last thing here, Mike, to think about. When you're up a lot going into the last month of the year, like we are, we're up 20% or more going into the last month, like we are. I went back like 40 years. The last 10 times this happened, December's been higher, 9 of them. Up 2.4% on average, so better than average returns. A lot of stuff I just said there. It's a bull market. We still think there's going to be a chase into the end of the year is the best way to put that.
Yeah, and that sort of underlines the idea that usually strength begets strength in markets, and it's not something that you pull forward gains and then you're left with give back necessarily. But how are you thinking about things like, well, sometimes the third year of a bull market, which we're just in now, is a little bit less generous. First year of a new president's term sometimes is choppy. And even after you've had these years like this year, we're going to hit the 53rd record high of the year for the S&P. When you've had those clusters of new highs, usually it's still a bull market, but again, often a little more of a turbulent period at some point over the following year.
You're right, and we're in that camp. We still think it's a bull market, yes. But Scott, you had a great discussion earlier before I came on. Scott talked about some of those other areas that are taking the baton, right? Small caps, mid caps, industrials, financials. I mean, it doesn't mean just tech has to be the leader here. There's going to be other groups, I think, is how we see this. And the other thing I think is so I hate to say though, this time is different. Believe me, you hear that, turn off the TV, run the other way. What is happening right now though? We have really strong productivity in our country for the first time since when? Since the mid to late 90s. When you have strong productivity, go back and look in the history books, everyone. You tend to have higher GDP, higher earnings growth, and better stock returns, right? We gained 20% 5 years in a row in the late 90s. We're not saying that's going to happen again. But when you have the higher productivity like we see here, Mike, we think, again, those are reasons to think this bull market's alive and well. Probably don't gain 20% next year, full disclosure. But listen, between 10 and 15, maybe closer to 15, it makes a lot of sense still with the strong productivity and overall strong economy we still have here.
And as long as Trump's 100% tariff threat does not derail our markets, I don't think the economic data is going to derail our markets. Keep in mind, I'm calling for a correction in Q1 2025. Really, once we start to get January and February jobs reports coming in, that's That's where I think you're going to start seeing some of the weakness. But until then, as long as nothing really shakes confidence in a, extreme degree, then you're probably going to see a chase into year end. I think that's pretty accurate. And markets are probably going to move higher. Now, the S&P probably only to like 610, 615 maybe, but you could see small caps, the equal weight S&P, you could see mid caps and cyclicals really push higher here into year end. Again, I want to point out a lot of people are bearish in the comment section of these videos, and the sentiment is at 1 year highs for people being bearish. That's usually when stocks do well, is when people are bearish. So let me know what you guys think about this information down below in the comment section. Give me your take on this. Do you think the 100% tariff threat is an issue? Do you think Wall Street's going to blow it off? Because what are the odds that China and India stop doing business with the U.S.? Like, I mean, no. That's not going to happen at this point. For the BRICS? No, obviously not. Okay, so let me know what you guys think down below in the comment section. I will love your thoughts nonetheless. You guys have a great rest of your day, and I will see you in the next one.